Hey everyone, welcome back to Follow Me 11B. Discussions on current events, macroeconomics, and freedom and liberty from a veteran's perspective. Before we get started today, I just wanted to remind everyone to please like this video, subscribe to the channel. It really helps to affect the YouTube algorithm and helps us to get the word out there, grow the channel, grow the brand faster. Now, for today's video though, I wanted to discuss today's announced 75 basis point rate hike from the Federal Reserve by Jerome Powell. So to start things off, let's go straight to a Reuters news article from today, July 27th, 2022, and it is entitled, Fed Jacks Rates Again, Powell Vows No Surrender in Inflation Battle. And it's by Howard Snyder and Ann Sapphire. Let's see here. Here's a few bullet points. Fed raises policy rate to 2.25 to 2.50% range. Fed's Powell says failure to tame inflation is not an option. Here it goes something like this. Washington, July 27th. The Federal Reserve said on Wednesday it would not flinch in its battle against the most intense breakout of inflation in the United States since the 1980s, even if that means a sustained period of economic weakness and slowing jobs market. As he explained, the logic behind the stiffest interest rate increases in roughly 4 decades, Fed Chair Jerome Powell was peppered with questions about whether the U.S. economy was in or on the cusp of a recession, a notion he rejected because U.S. firms continue to hire in excess of 350,000 additional workers each month. Here's a quote. I do not think the U.S. is currently in a recession, he told reporters after the end of the U.S. Central Bank's latest policy meeting, citing an unemployment rate that is still near a half-century low, and solid wage growth and job gains. Here's another quote. It doesn't make sense that the U.S. would be in recession. Doesn't have to make sense. It just has to make sense in terms of the numbers, Mr. Powell. But I digress. But the 75 basis point rate increase announced by the Fed on Wednesday, coupled with earlier actions in March, May, and June, has now jacked the central bank's overnight interest rate from a near zero to a level between 2.25% and 2.50%. That is the fastest tightening of monetary policy since former Fed Chair Paul Volcker battled double-digit inflation in the 1980s. The cure then involved back-to-back recessions. Consumer prices haven't yet breached the 10% annual mark this time, but at 9.1%, they are close enough to raise the stakes for both the Fed and the Biden administration, which is particularly sensitive on the issue ahead of congressional elections in November. While Powell said he did not think a recession would be needed to fix the problem this time, he acknowledged that the economy was slowing and would likely need to slow more for the Fed to bring the pace of price increases back to earth. Here's another quote. We do want to see demand running below potential for a sustained period to create slack in the economy, Powell said in a news conference. We're trying to do just the right amount. We're not trying to have a recession. But he was adamant that the behavior of inflation would drive the Fed's course and that another unusually large rate increase could be appropriate when the Fed meets if inflation does not begin to slow. Powell and many of his Fed colleagues have been caught out this year making policy commitments based on data, particularly on inflation, that has surprised them in negative ways and forced them to adjust on the fly. The Fed chief offered little specific guidance about what to expect next, a fact that puts a heavy focus on 2 months of upcoming data. The Fed's usual 6-week interlude between policy meetings is 8 weeks this time, providing what Powell called quite a lot of data to digest, including July and August inflation readings that will either show evidence of slowing price increases or not. Here's another quote from Powell. Restoring price stability is just something we have got to do, Powell said. There isn't an option to fail. When measured by the Fed's preferred gauge, inflation is running at more than 3 times the central bank's 2% target. And of course, we all know that preferred gauge is highly suspect and is likely far more, probably double what the 9.1% says if measured by the way it was measured in and around 1979, 1980. But back to the article. Fed officials are acutely aware of the hardship that inflation imposes on American households, particularly for those with limited means, Powell said, and they will not relent in their effort until presented with compelling evidence that inflation is coming down. While job gains have remained robust, officials noted that in the new policy statement that recent indicators of spending and production have softened, a nod to the fact that the aggressive rate hikes they have put in place since March are beginning to bite. New data due to be released on Friday will show to what extent growth has slowed in the second quarter. Normally, that would be your indicator, yes, yea or nay, of if we are in an official recession. More on that later. Powell said some of the impact of Fed rate increases to date is still building in the economy, and depending on how inflation responds in coming months, that could allow the central bank to begin to slow the pace of rate increases. The policy rate is now at the level most Fed officials feel has a neutral economic impact, in effect marking the end of pandemic-era efforts to encourage household and business spending with cheap money. The rate also matches the high point of the central bank's previous tightening cycle from late 2015 to late 2018, a level reached this time in the span of just 4 months. So, another quick stat, December 2018, I believe, was the last time that the Fed rate had reached this level. So, like they say, late 2018. I believe it was December. But once more, we will continue. Investors expect the Fed to raise its policy rate at least half a percentage point at its September 20th and 21st meeting. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then, Powell said. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Future markets tied to Fed policy expectations tilted somewhat back toward a more moderate increase for the next meeting as Powell spoke on Wednesday. In the U.S. Treasury market, which plays a key role in the transmission of Fed policy decisions into the real economy, yields on the 2-year note moved lower. The yield on the 10-year note was little unchanged. Stocks on Wall Street added to broad gains in the session, with the S&P 500 closing 2.6% higher, while the dollar, the DXY, weakened against a basket of major trading partners' currencies. From here, it is possible that the Fed slows its tightening pace, reassured by the likely peaking of inflation and pullback in inflation expectations as oil prices have fallen, Seema Shah, chief global strategist at Principal Global Investors, said in a note. However, with the labor market still a picture of strength, wage growth still uncomfortably high, and core inflation set to decline at a glacially slow pace, the Fed can certainly not stop tightening, nor can it downshift gears too much. All right, so that's pretty much it for that article. Wanted to talk a little bit about the markets. As they mentioned, S&P closed higher today. The Dow also closed higher, and the NASDAQ closed higher. So why would that be when the interest rates are rising? Well, I was browsing several articles, and most economists out there believe that this is because Powell has indicated that this will likely be the end of the larger than average rate hikes. So you might see another rate hike of 25 basis points or 50 basis points, but economists are kind of, and the markets are kind of taking into consideration that most rate hikes coming in the future, which they do expect more rate hikes in the future, will be much smaller than a 75 basis point or 100 basis point rate hike. So just because of that, just because of the possibility of rate hikes that they were already expecting being lower, now the markets moved higher. But what is this going to mean? Well, one more thing about, before I forget to get to it, they were talking about on Friday, we're going to have some GDP numbers released. So this could indicate a second consecutive quarter of GDP. What have we got so far? Right now, we've got a first quarter of GDP, negative GDP. We are likely going to have a second quarter to be announced later this week of negative GDP, or possibly just flat GDP, maybe slightly up, but many economists are predicting it might even be negative. Now, if it's negative, normally 2 consecutive quarters of negative growth equal recession, the R word. But as you may have noticed if you've been watching the news at all in the last few days, the Biden administration is working on redefining the definition of recession. So even if we have a second consecutive quarter of negative growth, according to Joe Biden and his administration, we actually might not be in a technical recession yet, even though that's how it's been for I don't know how many decades. But what do we have right now? We've got at least 1 quarter of negative growth. We've got a slowing economy, retail. We've got slowing housing. We got rising gas prices. CPI is at 9.1%. But the unemployment rate is low. So that's kind of their bread and butter right now. That's the only thing they have to hang their hat on. So that's one of the things that they're kind of touting with this redefinition of recession. So things aren't good, but according to Washington, D.C. and their redefinition, things are going great. Might have a different, I personally have a different definition of how things are going, but we've got ourselves a broad-based economic slowdown. And that is what Janet Yellen recently spouted off as I believe that was an exact quote, broad-based economic slowdown is, they're looking at a broad base of items, and you have to have a broad-based economic slowdown. And in my estimation, that's what we have though right now. So going by the old definition of recession, or even going by the new definition of recession, I think we've got ourselves the R word. But I could be wrong. I would love to hear what you guys think about the rate hike today. Was it too much? Was it too little? Is it just right? Are we headed into recession? Or indeed, as Joe Biden and his administration have said, just because we have 2 consecutive negative growth quarters, that doesn't necessarily mean we're in recession. What do you think? I'd love to see it in the comments below. And while you're at it, don't forget, we are growing. We are Follow Me 11B on Facebook, on YouTube, on Gettr, and on Twitter. And we are at The Real Follow Me 11B on Instagram and on Rumble. And we will see you all on the next video.